All right, well, hopefully that's enough time to get all of our participants in on the line. Appreciate you carving out some time for us this afternoon. So as I mentioned, hello, everyone. I'm Brad Long, Deputy Chief Investment Officer and partner here at Fiducient Advisors. And I'm really excited to have Jared and Franz on the line with us here today. So I'll give you a little bit of the rules of the road for our next 30 minutes. And then we'll dive in because we got a pretty packed agenda. So 30 minutes on the clock. We'll be respectful of that. We want to make sure to get you to your next virtual or physical meeting at the top of the hour. So we are going to subdivide that with the first few minutes here from Jared on just kind of lay of the land of his view of the economy, markets, et cetera, from Capital Group. Then we'll start to come in with questions. So regarding questions, please feel free to submit questions as we go. You can submit them in the chat queue. They'll come to us. We will try to weave them in throughout. If we can't get to them, we have some dedicated time at the end for questions. If we still can't get to it, don't worry. We will follow up with you individually and we'll make sure we address your questions. So today's speaker, we're super excited to have Jared and Franz. He's a Ph.D. and economist with Capital Group. Capital Group oversees over $2.2 trillion as the end of 2022 and has a wide swath and view of markets, both here in the United States and abroad. So Jared, we're really excited. So why don't you give us a little bit of the kind of lay of the land as you see it today, and then we'll start coming in with some of our major questions for the participants on the line.
Great. Thanks, Brad. Appreciate everyone being here today, especially after a long holiday weekend. Let me just first start with how my group fits in with the broader investment group for about a minute or two. I think it's interesting and distinguished from other groups you're probably familiar with. So I'm an economist here at Capital Group. I was at T. Rowe Price before this. And I will say the way the economics team functions here at Capital is that we're embedded with our investment group. I actually sit on the equity side, and though I do support the fixed income side, I do predominantly most of my work here on the equity side. That's different than I think a lot of other firms that you're probably familiar with. For example, when I was at T. Rowe Price, one of the things that I didn't even know until I came to Capital is that equity PMs and analysts actually listen to the macro, right? Before at T. Rowe, it was all fixed income. It was, that's the natural place for an economist because of tips and rates and the Fed and all that stuff. And so here at Capital, I sit on the equity side. And that's really where most of my work is done. So with that said, a lot of the lens I have is really through company meetings with management teams on whether it's industrials or technology, but also with my macro lens of just the bread and butter inflation outlook and all and growth and the Fed. So let me start with first how I see the current market environment. Right now, I have a recession built into my base case forecast. It's a mild recession, so think down -1%. And then nominal GDP could actually continue to be positive. So with that -1 real and 2 or 3% inflation, you're looking at a nominal GDP environment that could actually be positive. That's different than recessions we've seen in the past. It's a pretty mild recession. If you think of the spectrum of recessions that you're probably used to, the GFC being very deep and long, 18 months and down -4%. And you think of the 2001, 2000 recession as being barely negative. The recession I think we're going to be looking at this year is going to be more towards that milder side. So that's thing number one. Thing number two is that while I do expect a mild recession, I expect a punchier or a stronger recovery coming out of this recession in 2024 and into 2025. There's a couple of reasons for that. Reason number one is because I think the labor market and the structural changes that have taken place since the pandemic are real. They're not going to go away easily. So those mismatches that we hear about, people looking for labor, whether it's in nursing or teaching or in manufacturing, that's going to take a very long time to really shake out of our system. So I have that labor market strength, even coming out of this recession, much stronger. And as you know, when people have jobs and unemployment rates are low, that leads to consumption. And since the US has roughly 2/3 of GDP as consumer spending, that's the transmission to a stronger recovery on the consumer spending side. So remember, after the GFC, we had a very weak recovery, especially on the consumer, but also on the CapEx side. That leads me to the next component of why I think this recovery is going to be stronger going forward versus the GFC and others. In 2024, for example, I have the legislation that's been passed to date. That's the IRA, the Inflation Reduction Act, the IIJA, this is the Infrastructure Act, the CHIPS Act. A lot of fiscal policy, I think, is being underestimated by the street and by others. So I think we've seen non-residential investment. We've always heard about this, right? Why hasn't CapEx been stronger in the US? Why has it been so weak for the last couple of decades? We're at 7% of GDP in non-residential, private non-residential capital expenditures. I think that could go to 10%. We could see something like a late 90s investment cycle in the US, but for different reasons, right? So we're seeing that with reshoring, energy transition, simply building factories for domestic consumption. We're going to see a lot of that happen. I think it's just getting started here in 2023. And this will have long tailwinds. So not just a 1 year or 2 year thing. The numbers and analysis that we've done is that it'll more likely peak towards 2027, even 2028, and could even have a longer extension beyond that. A big reason for this is because it just takes a lot of time to get projects going. And we're just starting to see the early beginnings of these projects taking shape. And we're talking a couple $1 trillion. If you add on multipliers to that, so that every dollar you spend, it has a multiplier effect on the economy, it could be something like $2.5 trillion or even $3 trillion. So it's big money coming into the economy over the next 5 to 10 years. So I have a stronger consumer, stronger investment side as well. And that leads us to kind of this, what's happening on the global side. I'm essentially more pessimistic on China. I don't think they're going to come out of this quickly. Even the rate cuts that we heard about over the weekend are not going to be additive, not going to bring them out of this funk. If you look at the next 5 to 10 years, I think it's going to be difficult for China to really accelerate growth. So growth versus the GFC. So a lot of things that are different from the GFC is that we have a stronger consumer in the U.S., stronger investing landscape in the U.S., but a weaker China, which was the opposite coming out of the GFC, right? We had a strong China and weak domestic investment. So those are that's the landscape for where we're going. As we get into, Brad, like what's happening kind of near term with the Fed and kind of the incoming data, I'm happy to talk about that. But I just kind of end with with opening comments on productivity, which is something that I like to think about a lot, where I did my dissertation in productivity. I think what we've seen up to this point has been a very weak productivity environment in the US. Almost 2 or 3 decade lows, we've seen negative productivity. And as we think about things like generative AI and some of the things I know folks have read about, ChatGPT, I think it's actually much bigger than that. It's not just about kind of having these LLMs, large language models, write little research reports for you. It's actually much broader than that, and we can get into that later. But I think it's going to have a disruptive impact on the U.S. economy. I'm a glass half full type person. I think history suggests that we tend to navigate this over multiple cycles. And I think the U.S. has generally been the place for innovation. That's where these were invented. Google invented the transformer models that these technologies are based on. The U.S. tends to do really well coming out of this, but it's going to be disruptive. But lastly, I just say, like, the productivity environment could be much stronger. So I'm talking, accelerating to 3 or 4% productivity, which will keep unit labor costs down in the future. So I'm pretty optimistic about where we're going, despite the fact that I think the near term, the next 6 months, are going to be bumpy because we are going to go into recession. So with that, let me stop there and hand it back to you, Brad, for some some questions.
Yeah, there's a decent amount to pick through there. So why don't we just kind of even on that level setting, you said about negative 1% real, right? So why don't we help put some framework around that? What is inflation there in your forward view? And then we also had a question come in on, is that negative 1% for the total of 2023? So the back half is actually going to contract more and on average be 1, or is that 1.25? So help us frame that a little bit before we even dive deeper.
Yeah, so I'll take the second part of that. I mean, right now we've already printed a positive first half. If Q2 data looks like what it does look like, we're gonna have a positive Q2, roughly 2.5%. To get to -1, you therefore have to have a much weaker second half, and that's what I have. I have a weaker second half. We're seeing it. We're starting to see jobless claims rise. We're starting to see other parts of the economy, I think, slow, especially employment. Start to slow more. I need to get to that -1% for year-over-year GDP. I need for job growth to print negative, right? You don't get higher unemployment rates without printing job growth numbers that are negative 50,000 or negative 100,000. I need those for my outlook to work, for those to come negative. So I do have in the second half of this year, and we're already kind of in the second half already, but I need for those job growth numbers to go negative, and I'm thinking in my base case negative 50 to 100,000 in the second half of the year. Unemployment rate goes from what it is now at 3.7% to something more like 4.5, 4.75, or something like that. Now, normally in the average recession, if you take all those recessions post World War II. The average recession is down -2, and the unemployment rate rises 3.5 percentage points. So I'm looking at a percentage point increase in the unemployment rate versus 3.5%. It's a much milder recession, but I do need those numbers to come in negative. Now, what happens when those numbers start coming in negative? We start getting consumer spending coming in negative. So that labor market growth extends into consumer spending, which then makes my consumer spending profile in the second half of the year look like -1.5, -2. So that the labor market drives the consumer spending side, which drives that second half of the year weakness. That's where I am in terms of the arithmetic of GDP. In terms of inflation, what I've been saying up to this point, and looking at the year at the beginning of the year, I was talking about 4% type inflation growth in the second half of this year. And so I think of that as core underlying inflation, that we'd be at roughly 4%, not the year over year, but the core underlying inflation pace would be around 4. The numbers we've seen over the last couple months have been weaker than that 4. If you look at inflation, which the Fed has now, I wouldn't say kind of re-estimated or come up with a new metric, but they call this super core, right? So it's core inflation, which excludes food, excludes energy, but now they're calling it super core, which excludes the housing related metrics. So I'm going to take those housing that have already been high, and because of the way they're surveyed, will have a lagged effect on CPI. I'm going to take out food and I'm going to take out energy. That super core measure we saw last week in the prior release on the CPI, that measure was looking more, actually had a 2 handle on it, a 2.8% rate for 2 months. And so relative to my 4%, which I thought we'd be at, we're actually printing a little weaker on that. But for right now, I'm kind of keeping it at that 4. I'm not sure if I'm going to downgrade it yet, but it does suggest that we go, at least in my base case, we go from where we were very high inflation last year to 4 to 3% sustained inflation in next year in 2024, and then not to 2, but to 2.5 or so in 2025. So I have this gradual slowing in inflation, and so the incoming data are showing some a risk to that view, that it's weaker than we think. But for now, I'm going to stick to it until we see some more data.
So maybe on that 2.5 forecast, right? The Fed is very publicly post Jackson Hole said 2% is the right inflation number. The Fed, came out last week paused, skipped, call it whatever you want, on rates, but then in commentary afterwards said, hey, there's probably more wood to chop here on inflation. There might be more rate hikes in the future. Many are really anchored on 2. Do you share the same view that, if we don't get precisely to 2 with PMI or, whatever super core, that the Fed has to be hiking, or if we're at 2.5 or 3, is that sufficient, right? How much should investors really anchor on 2 as the magic number?
This is a long debate in macroeconomics. I think if the Fed had it to do over again, right? There's also this kind of, where did 2 come from? Like, we all talk about 2 and where did it come from, right? Why 2? Was there some, in-depth empirical analysis that like 195 central banks did and decided on 2?
Well, there's a dice at the Fed, right? And they rolled it and it landed on 2.
And if you look at the transcripts back in the 80s and in the 90s, and when central banks were starting to come out with these targets, there was really it was 1% was considered too low, too close to deflation. 3% was considered too high because maybe you didn't get the inflation out of the system from the 80s, and they kind of thumb in the air, just kind of landed on 2. So there is nothing magical about 2. Now, what I will say, what is magical about a central bank and about an inflation target in general is that whatever you decide it is, whether it's 3% or even 4%, whatever you decide that inflation target is, what's magical is that the Fed is, or any central bank, is dogmatic about achieving it. Like, they want to get to 2%, and they have these tools, right? They have rates, they have a balance sheet, they have forward guidance, they have these tools to get to whatever that thing is, that 2%. And over time, you're never going to hit 2 sustainably for multiple years, but over time, you want your mean reversion. You want to mean revert to that 2. So if you're too high, you come back to 2. If you're too low, you come up to 2. And that target is achieved kind of on a trailing basis for, let's call it 3 to 5 years or something like that. And whether that's a target of 2 or 3%, it really doesn't matter, as long as the Fed is committed to getting back to that target, and as long as the markets believe them that they're committed to getting back to that target. So what's less important is the 2. What's more important is deviations around that 2. Now, what will the Fed be comfortable with going forward? My suspicion is that they won't be comfortable with anything with a 3 handle. They don't want 3.5, 3.8%, or even 4, anything higher. They will be comfortable with anything below 3, and even 2.5, 2.8%. And they'll say, if the numbers, like we said from the earlier CPI reports, that super core, are starting to come in more like 2.5, 2.8%. My suspicion is that they'll be okay with that and say, that half a percentage point, or maybe that full percentage point, if it's 2.999 or something like that, that last percentage point, we'll deal with that over time, meaning that we'll keep rates a little higher for longer over time and squeeze out that last 1 percentage point over time, rather than trying to get it all done in the next 6 months or a year. So they'll be comfortable with that higher 2%. The reason they'll be comfortable with this is because if you ask consumers, if you ask the public, what, and there's a few economists that have done this, some really interesting recent research, where they ask consumers, when going back to the Greenspan era, Greenspan always said inflation is a rate. We want inflation to be something that people don't think about. Like, in every day, people aren't complaining when they, go to Home Depot. They're not complaining when they go to restaurants. They want that inflation rate to be something that, like, is just in the background. It's not a part of everyday decision making or everyday planning. It's this kind of background thing. When you survey the public, when you survey consumers, what is that rate where it's a background? It's noise in the background. Survey after survey comes out and says roughly below 3. Anything below 3 is a rate of inflation that consumers generally don't care. They don't pay attention. They're not talking to the neighbors about it. They're not complaining about it when they go out to eat. So that's why I think the Fed will be okay. the empirical survey data suggests that they'll be okay below 3. And whether they hike another, they skipped. They said they're going to hike in the next meeting, I guess in July, and then they'll, skip. I don't know what they'll skip again and then hike one more. We'll see. But I'm less worried about the next, regardless of what you think will happen with these next 2 or 3 meetings. What I think we do know is that we're closer to the end of the cycle than we are to the beginning of the cycle, right? We're further away from that from beginning. I don't think we're going to 6.5% on the short rate. And if you look at the SEPs, which are the summary of economic projections, which were just published last week, no one on the Fed had 6.5% written as an estimate for needing to be at a near-term rate of that high. So I think we're closer to the end. If I'm, if we go into recession, if inflation starts coming down and we're below 3, I think that's a lot of, that's a lot less wood to chop. Let's put it that way, as you said earlier, Brad, a lot less wood to chop going forward. And if you look at 2024 and 2025, they have over 2 percentage points of cuts price built into their economic projection. So they have 100 next year, so a full percentage point, and then 120 in 2025. So the direction of travel is lower. And I think that's where we're going. As I said, we're going to be this time next year, I think in 2024, if we have the same economic panel, I think we're going to be talking about that recovery and talking about the Fed supporting that recovery.
So I want to transition to that because your point on, yes, recession, but punchier kind of consumer investment-led recovery, and talk about the strength of the consumer, right? Because we just talked about inflation, and even in spite of the strong labor market, right, wages have really not kept up with inflation, which is hard to do. A year ago, June, right, we were printing annualized inflation above 9%. And then, if you look at other like New York Fed data on credit card receivables, I think we were 986 billion, so almost $1 trillion for the first time ever, right? So we have a consumer that, if kind of your projections come perfectly forward, we're going to have increasing unemployment. You got a decent amount of revolving debt out there. Like, what gives you confidence on kind of the punchiness of consumers growing, spending in 2024 and beyond to lead that kind of exit out of a recession?
Yeah, I mean, the consumer has been so bizarre over the last 12, 24 months. And I mean, I think there's some ways to reconcile it, but, disposable personal income, wage growth, real wage growth has been negative for the last 2 years, right? If you had told me 2 years ago that we'd be in a sustained period of negative real wages for most consumers in the US, I would have told you almost logically that, well, that would mean that consumer spending also has to be negative. Real consumer spending also has to be negative. But what's happened is that we've had this divergence where real consumer spending is actually held up while real wages and real disposable income have been negative. So what kind of explains the gap? This is kind of squaring the circle a bit. Part of it is due to the excess savings that we had during the pandemic. It had gotten up to 2.8 trillion, almost 3 trillion in 2021 coming out of the pandemic, and has been slowly fading since then. So folks have been taking that excess savings and helping, instead of reducing consumption as real wages have been negative, actually using that excess savings to maintain consumer spending. So now we fast forward to now, right? And we're saying, ironically enough, that if these latest inflation prints are more like 3 and not 4 or 5, and the latest inflation is 3, wages are 4, ironically enough, we're actually going to be seeing positive real wages. But again, going back to like my outlook is that we're going to be seeing negative consumer spending, if I'm right. Again, all the caveats with if I'm right, and I've been wrong a lot, so don't take my word for it. That we'll be in this weird place where real wages are finally positive, but consumer spending is negative. Again, I think we can kind of go back to this idea of excess savings, that most of that excess savings is gone now. And so if you don't have this kind of treasure chest in the back room that you can kind of go to and spend when inflation is so high, that's gone, then you will see a realignment of consumer spending with real wages. And so what gives me confidence, at least going forward, is that, hey, yeah, I know we're gonna see some consumer weakness in the near term. But as I look to the future, what I think a few things that are coming to mind. Thing number one is that the labor market, like I said, is structural, not a cyclical issue, right? I think it's going to take time for folks to go back to their, those labor impaired sectors like nursing and teaching. It's going to take time for them to go back to those. Eventually they will. But also we haven't seen a crazy, like in other going into other recessions, we usually see a lot of leverage on the consumer side go into that, whether it's in housing or whether maybe it's on the business side. We see some leverage in those sectors. In the consumer, we really haven't seen that post-COVID. We haven't seen a big leverage cycle. And so I think the combination of still solid labor markets coming out of this that are structural, leverage that hasn't really accumulated. Another is balance sheets. We've seen the biggest increase in lower income balance sheets, so wealth effects. So the lower income consumer has actually seen a pretty decent balance sheet improvement over the last 2 or 3 years. That's keeping the consumer spending profile from getting too weak. So why not a -2 or -3 during this recession? I think it'll also be a tailwind going into 2024. So that's why I guess I'm more optimistic that coming out of this, the consumer will be okay.
Yeah. So Jared, in the last few moments we have here, sitting kind of within and embedded in a over $2 trillion organization that covers US, ex-US, you had some thoughts on China and Europe. Like, what are the biggest risks out there that you feel like are either mispriced or misunderstood today that you could leave, kind of our investors with to keep an eye out for?
I'll do, to be balanced, I'll do one positive one and one negative one. Well, I think the biggest negative risk, at least to me, is China, is the decoupling between the U.S. and China. We've heard about it, we've talked about it, but I think there's going to be real decoupling. It's not just, I don't want to trade with you. It's going to be like, I'm going to take my factories out. I'm going to take our relationships are going to separate. We're going to see really corporate decoupling between the U.S. and China. And also, I think China is not going to have this really strong recovery. Remember, they spent the last decade or 2 decades leveraging their economy to a property market, a housing market, taking on a lot of debt that I think in the end was unproductive, right? It didn't increase the productive capacity of the Chinese economy. In the end, I think the Chinese economy cares about one thing, is that the political elite staying in power. It's not economic growth. And so I think that's a real negative risk for any country that's exposed to China. On the positive side, I'll just go back to the CapEx cycle and say, I think markets and investors are really underestimating what's happening. If you look at these legislative documents are very detailed, they're very annoying, they're hard to parse out, it takes a lot of time. There is a lot of money in these documents that are just starting to ramp up in 2023. And if the work we've done actually pans out, then this is going to be a long cycle in CapEx that's going to really be 5, even 10 years beyond where we are now. So that's my optimistic risk.
Yes, a move from 7 to 10, right? That's 42%, growth and CapEx. That's good growth. So, well, look, Jared, we really appreciate you taking the time, kind of walking us through a lot of these very important issues in capital markets today. I know we had a lot of questions in the queue. If we didn't get your question, please feel free to reach out. We're always happy to address it on the side. But Jared, thanks again for carving out the time. We really appreciate it.
Thanks, Brad. Thanks everyone for joining. Appreciate it.
All right. Thanks, everybody. Bye-bye.